Hello, in this lecture we will continue on chapter 22 and we will now be discussing the cash budget. So the cash budget after developing the budget for sales, then the manufacturing cost and expenses and capital expenditures. The next step is to do the cash budget, which shows the expected cash inflows and outflows. So we are of course going to use many of the prior calculations that we have come up with in order to generate and produce the cash budget. So the cash budget is especially important because it helps the company maintain a cash balance necessary to meet ongoing obligations. So the cash budget is going to be something that we're going to try to keep at a constant level for the most part, much as we would do for our individual budgets. We want to have a constant level of cash that could be there for emergency, and we don't want it to go too far over or under that, because if we have an excess amount of cash, we should be either putting it somewhere to make money from it, investing it back in the company, or if we have no use for it in the company, we should be giving it to the owners. So remember, our goal here is not to generate cash in the business. Our goal is to generate revenue in the business. And if we achieve cash in doing so and accumulate cash, then we should either put that cash back in the business or we should give it to the owners so the owners can then do what they wish with it on their end. That's the point of the business: generate revenue, generate value, and give that value to the owners. So the general formula for the cash budget is this. We're going to take the cash beginning balance, what we started with at the beginning of the month or year or period. We're going to add to that the budgeted cash receipts, what we are receiving throughout the period in cash, not on an accrual basis. And then we're going to subtract from that the budgeted cash disbursements, the stuff that's going out in cash, not on an accrual basis. And then that's going to equal the cash balance, the preliminary balance. And then we're going to look at that. We're going to say, well, is that where we want it to be? Is that high enough for us to have a cushion in terms of an emergency situation? If it is high enough, or if it's over, then we might want to repay any loans with that excess cash. If, on the other hand, our cash balance is too low, we're saying, okay, we got some cash, but if anything happens, that's not going to cover us in case of an emergency. Therefore, we might take out a loan to keep us at this constant level of cash. So a budgeted cash receipt. So 40% of the company's sales are for cash. So first we're going to talk about the sales half, and we're going to say, okay, how much cash is coming in? Well, remember that cash coming in is different from revenue. So the cash coming in, we could think about revenue, but then we have to think about, well, how much of that revenue are we going to get in this time period, in this month, in this case? And we're going to think in this case that we're going to get 40% for cash, and the 60% will be on account. So of the sales that we make, of the work that we have done in this period, 40% of that will materialize into cash, hopefully, this period. The other 30% we're going to get within the 60 days, and we're going to get that next month. So on a cash, if we look at this schedule, the schedule of cash receipts, we're concentrating on the last quarter, October, November, and December, but we will need some information from September in order to do those calculations. So keep that in mind as you go through these budgets. We're really looking at the current quarter in this case, but of course we're going to need some numbers from the prior period in order to generate these numbers. So if we think about our first quarter, our first month within the quarter being October, the sales are going to be 60,000 less the ending accounts receivable, which is 60% of the 60,000 is 36, meaning we're left with the cash receipts from the sales that we made in the month of October of 24,000, or 40% of sales. So that's how much we're going to get from the sales that we actually did in October. Remember, what a sale means that we have completed the process, we've delivered the goods, and therefore earned 60,000. Of the 60,000 that we have earned, we're only going to get 24,000 this month. When are we going to get the rest? We're going to get the rest next month in cash. So that's the 24,000, but we're also going to get cash, of course, from the sales on account from the prior month. That's why September is here. Remember, September is not part of our current budget. September is there to tell us what the beginning balances are in certain cases. So in this case, we had 42,000 of sales last month, and we said that 25.2 would still be in ending inventory. Therefore, 40% of the sales from last month, we're going to get the cash for this month. So if we think about the cash that we got this month, it's 49.2 for October. If we think about November, same thing. Sales, the work that we did and earned revenue is 48, but we are only going to get 60 of that is what we're not going to get in this case. which is 28.8, and 40% of that is what we are going to get. So of the 40,000 that we sold this month, we're only going to get 19.2 of it this month. The rest of it we're going to get next month. The 28 we're going to get in December. Therefore, also we're going to get the 36,000 this month, the cash, from the work that we did last month and billed for it. Part of that 60,000, the 60% of the 60,000, we are getting the income, the cash now, even though the income was earned last month, and so on and so forth. So we have to do that distribution when we're kind of converting from an accrual basis basically to a cash basis when thinking of the cash budget. All right, so cash payments for materials. We have a similar issue with the payments. So when we make payments for, let's say, inventory, in this case, then we have the same idea or question. When do we actually pay the money? When do we record the materials? We record the materials when we receive them, generally. When do we pay the money? Well, we may pay the money in the next month, in the next 30 days. And in this case, that is the case. So what's going to happen is we're going to get the materials this month. We're going to record the expense or the asset of the materials that we have received when we have received them, but we may not pay it until next month. Therefore, cash will not be affected until the following month. So we have a similar type of idea that we need to take a look at in order to calculate that. Remember, we are only conducting our final quarter of October, November, and December of the year 2015. Materials purchased, 20,240. That's what's going to be on the books as a purchase as an asset for October because we received them. That's what determines on an accrual basis when we were going to record it. But in this case, we're saying that 0 of that is going to be paid this month. We're not going to pay for it until next month, kind of like if we bought it on a credit card. And therefore, we have this 7,060. Well, where did that come from? That's what we bought in the month of September. So in this case, we didn't put September here to show that calculation, but that is where that it's coming from. That's the September purchases that we had that we're now paying to now in October. And then if we take a look at November, the amount of purchases, the stuff that we got in inventory for November is 11,450. The stuff that we added to inventory, that would be the expense, but we didn't pay for any of it in November. We're going to pay for it in December. That's where this line is coming from, obviously. And then, of course, what we are paying is for last month's materials that we purchased in October. That's where this line is coming from. Therefore, the cash disbursements in November are 10,240, which is what we received in terms of actual inventory in October. So that's a bit confusing. That's what we have to think about, that we're converting, once again, kind of an accrual to a cash basis in that format. Then we can prepare the cash budget now. So now we have the beginning cash balance. We're going to add to that the budgeted cash receipts, subtract from that the budgeted cash disbursements. That will give us our preliminary cash balance. So if adequate, repay loans. That's what we're going to do next. If inadequate, increase the short-term loans. So what we're going to say is, okay, now we're going to come up with our preliminary cash at that point, and then what we're going to do, of course, is say, well, is that where we want it? Is it too low? Then we'll take out a small loan to bring us up to that point where we can cover any emergencies. If it's too high, then we can either pay off loans. If all the loans are paid off, then maybe we should give a dividend out to the owners. And additional information has a September 30th cash balance of 20,000. That's our beginning balance that we're going to have to put into this equation. And we'll have a cash dividend of 3,000. Remember what a dividend is. That's the cash that's going out to the owners. So obviously the owners at some point are hoping to get a return on their investment. One way that return can materialize is once the company generates revenue, they give the cash at some point to the owner. For a C corporation, that's called a dividend. So here's some added information that we have for the Sticks company. The company has an income tax liability of $20,000 for the previous quarter that will be paid in October. So we have to pay income taxes, obviously. So those will accrue, and we will then pay them in a similar fashion. The cash is going to go out for October, even though the income tax we are going to apply in the same format as when it was earned under the accrual basis. So we're going to purchase $25,000 of equipment in December. So that's going to be a capital asset purchase. Therefore, we're going to put it on the books as an asset. But when we think about cash, of course, we are going to decrease the cash when we pay the cash in the cash budget. Has an agreement with the bank for loans at the end of each month to enable a minimum cash balance of $20,000. $20,000 is our cushion, so we might want to do that on our personal accounts. We might do that on our personal accounts as well and say, hey, I want to have this minimum amount in case there's an emergency, and if I go over that amount, then maybe I should put that cash somewhere else, such as an investment for personal cash, maybe for a company, put it out as dividends or pay off a loan or something of that nature. So pays interest each month equal to 1% of the prior month's ending loan balance. So in order to keep us at $20,000, if we go below that, we're going to take out some small loan and therefore pay interest on it, in this case at a rate of 1%. Repays loans when the ending balance exceeds $20,000. So if the balance goes over $20,000, then we're over our safety net, and then we can pay off the loan if there's one outstanding at that point. Owes $10,000 on this loan arrangement as of September. So as of the end of last month, and we're going into October, we owe $10,000 for this short-term loan that we have done in the past in order to keep us at that $20,000 level. We have a tax rate of 40%. So any income that we generate, we're going to have to calculate the tax at 40%. We'll pay taxes for current quarter next year. All right, so then if we look at that, then here's our cash budget. And all of this, most of this information has been generated from the prior calculations that we've gone through in this process. Now we're just putting it together in the cash budget. Notice that we are in the last quarter, October, November, December. We've got the beginning cash, which is given to us in the problem. Then we've got the cash receipts. We calculated that above in Exhibit 2214. And remember, that's the receipts that we're receiving on basically a cash basis. We had to calculate the receipts that we got from this month's sales and what we received from the sales last month. Then we had the cash payments. Remember, we had to calculate the direct materials. That we calculated that before, just pulling the number down. Direct labor, same thing. We calculated, we're just pulling the number down. Variable overhead, we calculated it before, pulling it down. Sales commission, sales salaries, general and administrative, we've all calculated these before, and we're now pulling the numbers down. Income taxes payable, that was given to us in the problem. And then we said that we had 1% on the outstanding loan. The outstanding loan was $10,000 at the end of September. Therefore, we're paying 1% or $100 in October on it. And that gives us our total disbursements of $43,565. So we're going to take our cash available minus the 43, and that will give us our preliminary balance, which is the $25,635, and that's over the $20,000 that we need to sustain ourselves. That's where we want to be, at $20,000 at the end of each month. And we know that we have an outstanding loan balance. Therefore, we're going to pay the amount over the $20,000 off for the outstanding loan balance to bring us down to the $20,000. So we're paying off the loan of $56,335, leaving us with $20,000 in our bank account, and the loan balance is now $4,365. The ending balance in our bank account as of October is the beginning balance in our bank account as of November. Do the same process. Cash is going up by the $55,200. It's going down. We're going to get all this information from our prior analysis. Then we paid dividends. That was new information of $3,000, decrease in the cash balance. And we have the interest on the loan, which is now $4,365 times 1%. And that gives us our disbursements here. Our balance minus the disbursements means that now we're at $43,246, which is far above the $20,000 minimum balance that we want. Therefore, we're at $38,800 after we pay off the loan. So we're going to pay off the loan, then we're at $38,881, and we're far above the 20 now. So that's fine. We're in a place that we feel comfortable. Again, if we get too much cash at this point, we may want to invest it further, or we may want to invest it in the company. And notice what our decision here was. We're going to invest it in the company. We paid for equipment in December of $25,000 with that excess cash. So in December, our ending balance for November is our beginning balance for December, less the cash receipts. All this comes from our calculation before. Then we took that excess cash and paid for cash purchase of equipment that's going to help invest into the future. And that leaves us with a total cash disbursements here, giving us a cash balance of $44,706, which again is well above the 20,000 minimum we still need. So we're at 44,706. And then once again, we might want to think about putting that in something such as dividends to the owners, if not back into the company. Okay, so we have the budgeted financial statements then. So now once we have the cash budget, then we can use all the information we have to create the budgeted financial statements. So we can use the information we have to make a budgeted income statement, which would look like this. It looks very similar to a normal income statement. Only difference is now that it is budgeted, all the information that we have generated is enough that we need now to create this income statement. So these are the exhibits that are coming, the numbers are coming from. The 32 times the 60 gives us the sales. The cost of goods sold, the 32 units times the 17 gives us our gross profit. Then we pull the expenses inside. These are the exhibits they're coming from where we have calculated those. And then the expenses are we're going to pull out to the outside. The gross profit less the expenses gives us our income before taxes. Then remember our tax rate was 40% times the income before taxes is 39,502, giving us net income after taxes 59,254. Then of course we can create our budgeted balance sheet. So now we've done the income statement, we've got our cash budget, we can do the balance sheet. Once again, we have all the calculations that we need in order to do that. Assets equal liabilities plus owner's equity. The cash comes from our cash budget, obviously. Accounts receivable, 50,004. Raw materials, finished goods, and equipment, and so on. And then we got our accounts payable here, our income taxes payable, our common stock, and retained earnings. And of course, our assets equal our liabilities plus our owner's equity.